Welcome back to the trailer park, folks. Y'all, I am down 16% year to date. We're creeping up on $1,000 in the hole. Oof. What am I gonna do? Just load the boat best that I can. $120, my weekly buy this week, went into a recession-proof stock that I truly believe is one of the best deals on the market today. I used $100 of my dry powder money to go into building what I believe is going to be the cornerstone of my entire portfolio going into the future. And I think I dodged a bullet about a month ago that I want to talk about, and that's quite a bit, so let's get into it. Well, there's a big dip alert out on Elf Beauty. They are down over 50% from their earlier all-time highs, and to me, for no real reason at all. Let's look at these numbers together, and you tell me at the end of this if this isn't one of the best deals in the market today. Year over year revenue, these numbers come from their Q4 earnings. Year over year revenue up 37%. 37%. Year over year net income up 128%. Okay, getting a little excited, starting to see it. Diluted EPS up 116%. Let's go. Revenue. Well, let's see. Let's go to net profit margin. That's the next one on the list. Up 65%. Now we get to the analyst expectations. Earnings per share, they beat by 71%. Revenue, they beat by 6%. You starting to see it, starting to get the fever? Well, we're not even done yet. There's still more to see. PEG ratio on Elf Beauty, 0.8. We've talked about it before. Anything under 1, that's awesome. That means they got a lot of expected growth for the PE ratio that you're paying right now. Debt to EBITDA ratio, see kind of what debt they're looking at, see if they're over leveraged, got too much going on. 2.6. Anything under 3 is golden. 2.6, you bet we're all about that. I mean, getting excited, right? I said that this thing was recession proof, and I got 2 reasons why. One, women are always going to buy makeup. Historically, even they'll find the money to buy makeup. Even in the toughest of economic times, they still want to look nice. They still want to be pretty, and I appreciate that. Elf Beauty also has pricing power. So times get tough. Yeah, women want the makeup. They're also going to look for maybe a little less expensive makeup. And Elf is literally running at a fraction of the cost of their competitors. They've got pricing power. They can go up 50 cents on every product they got. It's not going to put a dent in their sales because they're still so much cheaper than everything else. Before I made my first buy into Elf, I called all 3 of my girls and I asked them, hey, have y'all ever heard of this? Y'all use this product at all? And all 3 of them loved it. One of my girls kind of summed it up the best. She said, it's the cheapest makeup I can buy that doesn't break me out. And I don't think that's going to be Elf's new campaign slogan anytime soon, but you get the point. They're going into $20,000 general stores. They just acquired the Rhode brand. That's going into all the Sephora stores. They just got a lot of runway. You look at those numbers we just went over. Look at their advantages even in tough economic times. Man, y'all, this is a stock that you can hang your hat on. Okay, next up, $100 of dry powder money this week went to the cheat code, SPMO. Y'all, a tightrope walker lives a whole lot longer if they're working with a safety net. And an ETF that holds 102 of the fastest growing companies in the S&P 500 makes for a pretty damn good net. 1 year returns, 24%. Compare it to SPY, you're looking at 16. And when you blow it out to 10 years, the difference, the gap gets even wider. 10 year on SPMO, 416%, y'all. SPY, we're looking at 274. Now you're starting to see SPMO, the cheat code, and it works the other way. I'm down 16% right now, but SPMO, year to date, I think is down like 6 or 7. So it doesn't decrease as fast as the other one. How these guys do it? They've got a system where they overweight the fastest growing, the stocks with the most momentum. They take all the stocks in the S&P 500 and they give them a momentum score. You get a big score, your weighting goes up. Get a bad score, your weighting goes down, and if you're below that 102, 102 companies that they hold, you're out. So they rebalance this thing twice a year, third Fridays of March and September. And so I got excited this week because we're at the end of March, and it's time to see which stocks made it into their top 10 and which stocks fell out. And I was pretty excited to see how it all went. So we've got the new SPMO top 10. The 4 that got pushed out were the mighty Meta, JP Morgan, Mount St. Amazon, and the Sultan of Swipes, Visa. The stocks that got put in, Micron, Johnson & Johnson, Caterpillar, and my big dog, AMD. At first I was like, wait a second, maybe this isn't good news. All these stocks that I have individual holdings on are not showing enough momentum to stay in there. But at the same time, I'm kind of glad about it because it reduces some overlap, right? Now I'm getting exposure to 3 companies that I don't already have exposure to. And a little heavier exposure in AMD, which I'm very bullish on. I'm looking forward to good things in the future on AMD. Caterpillar is one of those that, man, whenever I very first started, I had no clue what I was up to. I was throwing darts at a dartboard and picking stocks based on a story that I could wind up in my head. And Caterpillar was one of those that I bought. But then I started learning a little bit, just a little bit, not enough to really know anything, but enough to be dangerous. And I saw the big PE ratio and I went, oh, that's too much on the little bit that I've learned, and not really knowing how to dive deeper in to see if a PE is justified. And so I sold it, and boy, that was a mistake because it's had a really good year and a half. I would have made a little money on that if I'd have stuck in at what I bought it, 15 months ago. But so I'm glad about how it's gone. I like it. It's less overlap. So that $100 that I put into SPMO this week took it to the second largest position in the portfolio. It's up to 10.5% now. I'm going to take it to at least 15. I want it to be the biggest position in my portfolio. And honestly, I can see a time where it might end up being 30, 40% of my portfolio. This might be the true anchor of this whole thing. They're doing great things. You saw the numbers for yourself. I've got big plans for this one, and hopefully they got big plans for me. All right, so I said we're going to talk a little bit about this bullet that I dodged about a month ago. I told you I was thinking about buying GDX, the gold miners ETF, and ended up going with DTCR, the data center real estate ETF instead. And boy, I think I dodged a bullet on that one. GDX is down 27% just this month. The central banks, the other countries are all starting to sell their gold reserves. All this gold that they've been buying up, now they're starting to liquidate it again because we've got things going on that are affecting the economies of these other countries. Felix Preen was talking about Turkey, that they had been, over the last decade, been one of the biggest buyers of gold. But then over the last 2 weeks, they have been a massive seller of gold. They got energy crisis issues and economy issues that they got to liquidate that gold holdings to put back into their economy and be able to spend. So we're seeing a dive on it. My whole thesis on GDX was cheap diesel and rising gold prices, and all that's out the window. I don't think gold is done. You know, I don't think that once all this is over, I believe that it'll go right back to doing what it was doing. So I dodged a bullet, not that I didn't buy it, but when I bought it, because now that it's down like this, I'm actually thinking about diving in. We may come back next week and I may have some GDX. I'm going to do a little bit more digging into it to make sure. There's a good chance. All right. Before I close this thing out, I just want to say a couple of things. Y'all stay strong. Keep buying. This too shall pass. We're not investing money to try to pull it out next week. We're not investing for money next month. We're not investing for money next year. I'm investing for old man me. Old man me. And I believe that old man me is going to be really happy that I was investing during all these down economic times, that I was in there buying Meta at $5.50, buying Elf Beauty at 50 some odd dollars. I think old man you would be happy if you did the same. I'm not an expert. I'm a dude who lives in a trailer. But these are the times when money can be made. And I'm new at this. I'm going off history. I'm going off what people who are supposed to know more than me are saying. But hang in there. Don't sell off at a loss. Don't bail out. Cash is just going to lose value. Stay in the market. Keep buying. We'll come out of this on the other side smelling like a rose. Old man me and old man you will be happy we did. Remember, folks, we may never get rich at this, but there is nothing wrong with trying to get a little bit more than what you got. We'll see y'all next week here at the Trailer Park.